The markets keep rising. The Trump administration has announced some major trade deals and a massive AI plan. All eyes are on Jerome Powell and the Fed's FOMC meeting this week. Will they cut rates? Will Powell resign? What are they going to do about the AI revolution? And what does it all mean for investors? That's all going on this week. Welcome to the Milk Road Macro podcast, the podcast that knows that when Donald Trump shows up in a hard hat, your central bank might have a few problems. I'm your host, John Gillen. Today, we are joined by the brilliant and wise PDS, former head of macro for the George Soros family office, and one of the sharpest analysts in the world at the intersection of macro and crypto. So if all this sounds good to you, make sure you like, subscribe, share this episode with someone who would enjoy it. And a reminder, if you are listening to this episode on the Milk Road Show, these Macro episodes will soon only be published on the Milk Road Macro channel. So you can listen to this show on YouTube, any other major audio platforms, Spotify, Apple Podcasts. Make sure you subscribe, stay ahead of the market, and get connected with us. We're really excited about this. It's going to be a great way to get a lot of really wonderful macro analysis out to our community. As I said, my name is John Gillen. I spent 6 years at BlackRock, where I was working with and learning from some of the best financial asset managers in the world. I am now general partner at True Capital and thrilled to be the host of this program. To bring this great content to you all and to kind of focus in on macro here. Today's episode is brought to you by Definitive, the leading multi-chain trading terminal trusted by funds, DAOs, and pro traders alike, as well as Ledn. Get cash without selling your Bitcoin. And as every Bitcoiner knows, the first rule is never sell your Bitcoin. PDS, welcome to Milk Road Macro.
Hey, John. Good to see you.
Great to have you with us today. I'm really excited to get into this. So I know this is not your first time on the Milk Road Macro podcast. You have done a lot of great episodes in the past with us. And looking back at some of your prior episodes, which I was encouraged the audience to go check out if they haven't seen them, you talked a lot about the Fed's framework and gave a lot of insights on that. Walk us through how you see what they're looking at for the growth regime we're currently in and what you're anticipating coming out of this big FOMC meeting this week.
Yeah, thanks for having me again. I had a good time last time, so very happy to be here again. So yeah, I think that for this July FOMC, you want to take a two-step approach. One is kind of like assess what's in front of us, and I think this is kind of where the Fed is putting a lot of weight. And also think a little bit outside the box and try to incorporate all these dynamics that we're seeing on the labor market and on productivity side from the AI revolution. I'm very focused on that recently, so I'll spend some time on both, a little bit of what's really in front of us and how we should see the medium to long term. So I'm sharing my screen here. I think that to start kind of the leveling the playing field, I think it's important to kind of talk a little bit about what is different this year relative to previous year in terms of growth regime. Of course, this year is influenced by Trump administration policies. So first observation is that last year, especially the second half, we had a very strong growth environment in terms of consumption. Consumption kind of contributed around 2.75% of GDP points, which is around a pace of, call it 4%. We downshifted pretty meaningfully so far this year to a pace of around 1%, which is a below trend pace. So that's observation number one. We had a very strong economy on the consumption side. There are a lot of tailwinds to the consumer, even though until this moment, but now we're in a pace that is much more slower, and some of that is reflected because of the trade policy uncertainty and a little bit of the immigration impact as well on the economy. The other thing is, we had in private investment, we had a very strong construction boom in 23. Then we end up in a very strong environment for AI, capex, and now we downshifted to two things. Actually, I wouldn't say downshifted. We continue with the AI capex boom. That is very well socialized, but also we had a front loading in Q1 that added a lot of GDP points in non-residential investment, and some of this is probably going to be settle into a flattish environment of growth. I think for expectations for Q2 is already flat non-residential investment, and a lot of this is just because people anticipated tariff, imported capital goods and prepared for the tariffs ahead of time. And lastly, we've been in a very strong growth environment for government. That's downshifting as well. I wouldn't say it's downshifted as I expected. I thought it was going to propagate from federal and state and local, but we're kind of seeing is just the federal government is the one that actually contracted in Q1 and is expected to rebound a little bit in Q2. But state and local keeps kind of like adding 25 basis point to 30 basis point of GDP per quarter, and that's actually quite impressive. I will guess that state and local will downshift too as the federal government continues with the efficiency program, but we have yet to see some downshift on that. So that's kind of
Gotcha.
setting the stage of where we are on the growth regime, and I think what's important for the Fed ahead of time.
Gotcha. So you're saying that we've seen a lot of strength in the economy, but there's some uncertainty that's been introduced from some of these policies that the Trump administration has laid out. What is the Fed focused on the most right now? Is it inflation and price stability? Is it the labor market? What are they most dialed into, and what is going to be driving the decisions that come out of this FOMC meeting this week?
Yeah, that's a great question. So let's tackle this question with the screen that I just shared. So as I mentioned, there are two angles in my view here that we should be kind of like focusing on. And these are hard to measure, I would say, variables, but I kind of like always like to take an approach of like first principle, things that are intuitively right. So this table actually helps me a lot to kind of put together what's pressuring the economy right now. So on one side, we have the Trump policies, and we'll expand on which Trump policies, but net immigration, trade policy, obviously investment through the big, beautiful bill, etc. And then we have in my view, a very strong secular AI, general purpose technology adoption. And macro people like me are generally focused on the first part, on the Trump policy, because that's kind of in front of us, is measurable, even though it's hard to measure, but we can kind of have a good guesstimate of where things are going or where things are tracking. However, the AI adoption is much more difficult, and I think it's a new theme in the macro environment. But in my opinion, right now, the Fed, it's obviously much more focused on the Trump policies, and Chair Powell has mentioned these, that now they're focused on the impact on the economy from these policies, and not so much focused on the adoption of AI. This basically sums it up for me where the focus is. So this little table is a lot of us in the macro community when ahead of the SEP meetings, not this one, June was a SEP meeting, we tried to figure out where each member of the FOMC is going to pencil in his dot, right? And there are very good people for this. I generally work with my friends of MPP for this because they're very good, and they track basically every single one of the policymakers' commentary and go adjust pretty frequently their views. So I kind of benchmark myself with them. So these dots are generally the views that I share sourced by MPP. But then what I did to this, basically, did some deep research on policymakers' view on tariffs, and then try to characterize whether they are doves or hawks, and then also spend a lot of time going through research, publications, or speeches, or from again the FOMC participants in terms of AI economic impacts. To my surprise, there's basically only two members of the FOMC right now that are kind of very focused on this. One is Lisa Cook, the other one is Barr. Now, they have very particular views about impact on the labor market, and I would say more mainstream views on productivity. Most of the commentary of the FOMC around AI has been about productivity enhancement, and I think you can see on the table that this is pretty kind of mainstream. However, if you go into the labor displacement and labor job generation, which are two components of how AI impacts the labor market, you can see basically that 10 to 13 participants haven't expressed any views. So how do I read this? To me, is that the FOMC is basically focusing on what's in front of them, again, trade policy uncertainty, or trade policy, and you can see most of the FOMC is a hawk on tariffs, right? They're all worried about the pass-through of tariffs, even though we don't really have, I would say, good estimates of how much consumers are gonna share the tariff price hike, and that's kind of important because that's where we will see the CPI impact. But a lot of them are opinionated on this end, but they're not opinionated on the AI impact. And in my opinion, that means that probably the policy that we're going to have right now, it's a little bit more hawkish than it should be based on what the AI kind of revolution is influencing the FOMC. So I think that this is kind of a good way to to start thinking about, policymakers focus, perhaps make decisions or take views on how this actually impact the actual outcome. Net, I think July FOMC is probably going to be focused still on the tariffs story. So, markets pricing anticipated no cuts, and I think that's sensible. I tend to have a more dovish view, because I'm putting a lot of weight on the AI. And I think that this is just a matter of time that the FOMC picks up on this, because AI adoption is actually going at a very fast pace.
Gotcha. Okay, I want to come to. I'm really glad to have you on the show right now, because I do think that AI policy in Washington is a major topic, and figuring how that factors into macro is something that's really important for our audience to stay abreast of. I want to kind of just get a little bit more clarity for the audience. When you say hawkish or dovish around the impact of AI, clarify a little bit of what that means for the audience, and then we'll dive in a little bit more on AI policy. But I just want to make sure everybody understands when you say hawkish on that versus dovish, what that means, and what that means as far as AI's impact on the market.
Good question. And let's keep to one slide that I have. Back to first principles. These are complicated questions. They're not, it's going to be silly to have a sense of precision, but I think that one can have a good assessment on the direction of travel of how things, AI is pressuring policy. So I always go back to the growth accounting identity, which basically says that, potential GDP is just, it's approximate a sum of, labor productivity growth and labor supply growth. And why do I do this? Because labor productivity growth we can map to different factors that are related with technology diffusion cycles, and then on the labor supply growth we can tackle the question that it's a very popular one: AI is going to displace jobs, and whether that impacts the labor market in a negative way or in a positive way. So if you separate these kind of two components and then find the subcomponents, so a couple things to say. Potential GDP expectations because of this AI revolution, it's feeding through optimism about earnings, optimism about the technology sector kind of becoming even more dominant in the economy, and also are optimistic because AI is a general purpose technology. And there are many academic studies that show that when you have a general purpose technology adoption, the structure of the economy tends to change. And even Lisa Cook spoke about this in one of her speeches. This is kind of manifesting in a AI-led FCI loosening. And to your audience, that FCI loosening, when thinking about the components, what basically is happening is that the rally in stocks is loosening financial conditions via equities. There is an endogenous reaction to that keeps rates higher, so tighter than they should be. And until recently, we had a reaction on the dollar that also was contributing to an offset of this. But in general, AI is basically loosening FCI conditions. And one will argue that that's a hawkish pressure to the current policy stance. I think that's sensible. However, if you go through communications from Federal Reserve FOMC participants, there's basically not a single one that is focusing on FCI. Maybe Austin Goolsbee sometimes mention FCI because he's trying to keep things from escalating like to the dot-com bubble. That's kind of more of his angle. So that's argument one. But here is the most important one. Labor productivity generally dampens higher labor productivity dampens unit labor costs, and this is just because productivity is a residual in that formula. In other words, and maybe relating to the Greenspan era, we used to have a flat Phillips curve, which means that labor productivity actually creates growth that is not inflationary. How this transpired, there are many different ways. I don't think that it's worth to get into kind of the details, but I think that for me, when generally it's someone that tries to reduce dimension to one thing that I can remember, if someone tells you, well, productivity is going to go up, in order for me to translate the impact on the FOMC and the Fed reaction function, I'm thinking about NAIRU, which is the natural rate of unemployment that doesn't produce inflation, goes down. So if that happens, you have more policy space relative to where policy rates are today. So that's, to me, the most important, I would say, foundational principle to think about how AI impacts the Fed reaction function. So higher productivity. Then, before I go into the labor market, the Keynesians of the world, so everyone that sees government spending or consumption, they right away translate that into a pressure on inflation. They will think, well, we have going to have an investment boom. an investment boom generally, in order to kind of in macroeconomics, in order to balance the savings investment identity, that means the higher R star needs to go up. And it's kind of sensible to think about that if you have a lot of pressure coming from this massive investment boom, and people is competing for inputs to create factories and etc. Obviously, that would probably have some demand pull into prices, and it will create a harder economy than needed. And that's not even considering how they're going to fight for labor. I think that's a very important component, and generally the hawks of AI impact on the Fed reaction function will focus that first comes investment and then comes productivity gains. So they're like, well, we can't be too loose because we're going to have an investment boom and that's going to pressure things high. But then on the other side of that, another Dovish argument that I think is very important, there is a lot of debate here, is like what's happened with the labor market, right? And the way I think about the impact of AI on the labor market is simplistically divided in two. So you have a displacement factor, which is low skilled workers that can be replaced by a machine or a program that does the task more efficiently. And in the bad case scenario, that job is basically just cut, right? And that's you will probably hear a lot of people. One of the I'll show you in a minute kind of my scenarios, but there are people like the anthropic guys. They tend to have a more negative view on displacement, thinking that that's going to create a drag on the economy. But there's other people like Schmidt from ex Google CIO who actually thinks that displacement is going to be a kind of a smaller factor in the near term relative to job generation, and I side with that quite a bit. So it matters a lot how you think about it, but here's the important part to the framework is people that is worried about displacement generally is going to put a higher weight on that downside tail on employment. So, okay, first we're going to have this AI revolution. We're going to have all these new ways to replicate tasks that we've been doing. I don't need these jobs, and people figure this out in the next 6 months, so they cut jobs first before they realize, oh, this actually is giving me new avenues to make money, so then generates new business, right? So people that worry is more on the displacement short term, it's going to have a much more Dovish reaction function. Look, net to me, I put two Hawkish forces and two Dovish forces. I tend to think that the Dovish forces are much more relevant over the long run. I'm also someone that has adopted this technology, and I can already envision how my business is changing because I don't need as many people as I used to have in terms of analysts. I have now AI agents doing jobs like that. So I think this is a much more disinflationary force than people expect. So that obviously creates a much more Dovish pull into the FOMC reaction.
In traditional finance, whales use the Bloomberg terminal. In crypto, they use Definitive, the trading terminal built by Coinbase alumni, which lets you trade across every major chain out there. Definitive's combination of low fees and advanced order types like limit, stop loss, and take profit make it one of the best on-chain trading experiences there is. The kicker, Milk Road listeners trade free on their first 25,000 in volume. Visit milkroad.com/definitive and start trading like a pro today. Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn.
Look, I think this has been a lot of brilliant and helpful analysis. I want to make sure we kind of slow this down and synthesize this a little bit for the audience, because you just gave a really great overview of a lot of the theories and hypotheses in both directions, right? That the impact of AI is going to be inflationary, or like you say, there will need to be a hawkish stance by the Fed to sort of control the inflationary impacts. And then the dovish side, which is, what you're saying, the Fed is undercounting the non-inflationary productivity gains of AI that is going to lead to healthy growth in the economy. And so they need to have a dovish stance or not raise interest rates, or, as Trump is arguing, cut interest rates to allow the economy to grow in a healthy way. And what you're saying is that a lot of the governors of the Federal Reserve Board are leaning more in the dovish or hawkish direction right now, just so our audience knows which way the wind is blowing.
So if you take
Basically, I'm just asking, are they going to cut rates this week or in September, or do you think they're going to hold rates or hike rates? Distill this down so we can understand where all of these different prevailing winds shake out.
I think that because the Fed is putting more weight on trade policy, July is a skip. I think market has incorporated this well. In fact, the fixed income narrative is actually maybe no cuts because inflationary pressure are going to be higher. So the market, fixed income markets, and the Fed is putting more weight on what's in front of us, which is trade policy, impact on inflation, and add a little bit of immigration uncertainty that also creates some kind of like supply constraint on the labor side. And they were like, okay, I'd rather not to cut. We got to be patient. Let's wait for this. But here is my proposition. I think that Governor Barr has taken a intellectual leadership on actually thinking about what is the impact of AI. And he had a speech in May where he outlined two scenarios. One scenario with rapid adoption and disruptions, and one scenario with smooth. And he's taking more of a view that AI tends to be a disinflationary force and a force that actually should pull rates lower. In fact, let me caveat this very quickly. These are our estimates of where each policy maker kind of put on their dots. Bauman and Waller have been the most dovish members of the FOMC, and both are
dovish. Meaning rates. They're cutting rates, right? Okay.
Yes, and they pencil in September basically 3 cuts. The rest of the committee mainly 2, and then a group of hawks that including Barr. But this is what's interesting to me. Barr is also the most dovish member for 2026. Why is that? Well, he's the only one, in my view, expressing views on AI and how this impacts, and actually how it lowers NAIRU on one end, so you have more policy space, and also you have more risk of what they call frictional unemployment, which is people being displaced in the short term, putting pressure on the employment rate. Both of those forces are dovish forces, and he's the one that is leading kind of the charge on letting us know what the policymakers are thinking about AI impact from an official communication perspective. So it doesn't surprise me that Barr, I have it as the most dovish one, because he has this view that AI is a disinflationary force and puts risk on the employment side. So net, what that means beyond July, excluding any politics, that the pressure that the chair is feeling, which I don't think he's feeling, he's pretty solid on that end. I think they're still itching to cut, especially the leadership. I personally agree with that view. Again, as I'm putting a lot of weight on the AI, and one comment that I meant to one of my friends when I was working through this table is like, oh my God, we are probably the largest technology revolution of our lifetimes. Pretty sure most of the audience have already experimented with some general purpose technology app or something like that. Yet there's only 2 members of the FOMC out of 19 that have expressed a kind of a view on it. So I think that that's just a matter of time that all catch up, and when they all catch up, they're going to have much more dovish lean. Let me add one more thing. I think that also is going to help that inflation expectations have been kind of anchored, excluding the consumer metrics one that tend to be very volatile. And I'll give you a caveat on that. Most of the inflation expectations have been anchored. So my sense is that when we go over this hump of uncertainty of what's the impact of tariffs on inflation, once they realize that inflation expectations are pretty anchored, you're going to see a pretty dovish reaction function relative to where we are right now. Can that lead rates to 3%? I think that's my scenario. I'm a much more dovish macro guy these days. So call it 125 basis point of cuts by the end of 2026. That's without even assuming that we have weakness on the labor market. That's just from pressures that we are going to have growth, maybe employment that is okay, but in a disinflationary way because of this productivity kind of ether that we have.
Gotcha. Okay, very helpful. So, what you're saying, if I'm hearing you correctly, is that the Fed leadership is itching or looking for a reason, an opportunity in the data to support the decision to cut rates. And you think they're going to hold here in July. You don't know about September, but you're saying directionally in 2026, the dovish winds will prevail, and we should see some rate cuts coming in the future. I think the other thing I'll remind the audience, sir.
Sorry, I do think that September is a cut.
Okay.
I think September and December are likely cut. Maybe
Okay.
November, maybe the last two meetings of the year. But I think that they're gonna sneak in 50 basis points without any negative input from the labor market.
Okay.
We can talk about that in a minute too.
Yes, that's where I want to go next. But I want to just remind the audience that the Federal Reserve is not the only central bank trying to set policy and decide how to respond in this environment with trade deals, tariffs, and AI. The Bank of Japan is having a meeting this week, the Bank of China. So we in our Milk Road Macro newsletter are going to be covering that in much more detail, what's coming out of all these central banks and what to look for there. So just want to remind everybody to subscribe there if you're not, so you don't miss that. So we talked a lot about inflationary risks. We talked a lot about where the Fed governors are on these things. I want to come back to something you mentioned and get more detail on what you said about labor market risk. And I think one of the policies that the Trump administration has put in is ceasing the illegal immigration or crossings of the southern border. And so there's a lot of analysts with different opinions about how the combination of AI and the decrease in the labor market here, or the labor supply rather, in the United States is going to play out into the economy. What are you seeing in the labor market for the combination of these factors? Is the increase in AI going to make up for that loss in labor? Is this going to be a different kind of an outcome? What do you see happening there?
Yeah, this is not surprising that every single analyst out there or technologist is thinking about the labor market, because my views have floated around after some research, because it's not a trivial scenario for the labor market. So before we jump in the technology wave, going into this year, when you look at the labor market, I think that there were three things that are important to kind of carry on with you. One is that there's been narrow growth on jobs for a long time. Basically, when you get the NFP number every month, around 70% on average of those gains, or monthly gains, were basically concentrated in government, education, and healthcare, mainly healthcare, and leisure and hospitality. And this kind of been one of those post-pandemic dynamics. It's been very sticky, especially on the secular side, like healthcare. So I think that's very important, because now we're seeing that narrowness even more so. There was some optimism late last year when Trump won the election. There was kind of a rush to hire cyclical jobs, so anything that is not healthcare or education or government. But then that fade out, and literally we have had zero cyclical jobs this year. So one is the narrowness, and two is, besides these three sectors, all the rest of the economy is generating pretty much no jobs. Two is, if you look at the guts of the labor market data, particular flows, and I don't have this chart, but I'll post it sometime. I used to post it a lot in X, because the labor market generally is measured people coming in, people coming out of jobs, and these are 5-6 million people every month, and the net is kind of the number that you get, 500K each on the household survey, 200K on the NFP survey. But there are massive numbers going in and out. The characterization of the labor market going into this kind of Trump administration was, we had a pandemic, pent-up demand that was reflected on anyone that was out of the labor force and wanted a job, raised their hand, got a job right away. And we had massive amount of absorption, the way I like to call it. People coming to the labor market, and the labor market absorbs them. And we had incredible ratios of that. And that has gone down meaningful to levels that are historically been rather weak. And when you get an exogenous shock, aka like a global financial crisis, I'm not saying that that's going to happen, but we had a similar situation in 2007, 2008. We had a global financial crisis on top of a very weak, slow dynamics in the labor market, and you got a massive hit to the labor market. So this is to say that the labor market is fragile to exogenous shock that moving in one direction or the other one. So here's point number 3. What exogenous shock can we think of it? Immigration is that the number one, and it's very important because we have so many people coming into the country over the past 2-3 years, and we have such a big absorption rate in the labor market that all those unauthorized immigrants found a job like this, right? But now we're in the process of removing those excess jobs. I would say removing is the right word because we have some data coming in our way in regards to, for example, the temporary, the TPS programs, so temporary status program, I think it is. Maybe I'm getting it wrong, but this is basically you come to the country and you ask for a temporary status. They give it to you and you can actually work. Trump administration has been able to revoke around 150,000 of these jobs of these people. Half of those are probably working, so that's a hit of 400K or so that people, they're going to lose their job status and legally they cannot work. So immigration is very important. We haven't yet seen because there takes time for deportations to happen, takes time for this authorization revoke happens, and we're just seeing basically the flow of immigrants just stop. But if you put all these 3 together, the picture of the labor market was like one kind of in a steady state of no layoff, no hiring, with weak guts, the flow story. So here is the big question, and mapping it to AI. So we talk about the impact of AI as job generation factor and growth and displacement factor. And most of the technologies guys are focused on this, and they're focusing on the on the displacement factor. However, I'll mention a couple things here. I have 2 notes, and I think that's a good way to express it. This table basically gives you a GDP contribution. I built this table using a survey approach. So you take all the research out there of people that spend years and years doing labor market analysis, and they include technology diffusion, and you just take a survey of that and take a middle point. So these are not my estimate, these are medians of all the research out there. But just to give you 2 angles here, as I mentioned, Eric Schmidt, Google CEO, he thinks displacement factor is going to be low in the near term, and we're going to generate a bunch of jobs. So if you take this together in here, right, you get like a positive contribution to GDP of 50 basis points, right? So if the world were to be like Eric Schmidt thinks, in the next 5 years, we're actually going to get more jobs because of AI rather than less jobs. And we have more productivity, right? We're more productivity gains, and with more jobs, and that has a pretty important implication for policy because that means that actually the growth potential is going up. Right now, the other, Amode from Anthropic thinks that we're going to have a bunch of displacement, and he takes the other side of this, and basically he assumes that there's going to be 80 basis point negative contribution just from the labor market. This is per year, by the way, so it's kind of rather relevant numbers. Now, I take the view of Eric Schmidt, and I'll give you one good example. Pushback number 1 to everyone that is concerned about displacement and people that is coming from is finishing college and then they're coming to labor market, and now they have to fight AI that is basically destroying this layer of analysts, which is true. But I'll give you one comment. Young people is digital natives. They know how to talk to a machine. I have spent a lot of time with all the models, and I have a pretty deep dive process on all of the model. I kind of know which model is good for what thing. And the only way to get into a good place with a LLM is that you need to know how to talk to the model. So if I ask my dad of 77 years old to talk to the model, he's probably going to he knows how to do a prompt, but it's very unlikely that he has a pretty good iterative and iterative process. And you utilize memory and all these things that you can actually do to empower a user experience. Well, but the kids, I think that the kids are going to be very, very native to this. This is not just theoretically. So back to the growth identity. I'm just going to focus on this part of the growth identity, which is the productivity side. We talk about productivity. It's basically a function of how you and I are augmenting our work. right? The more we're manned, we're more productive. Now we have digital twins and we're operating in multiple, in parallel. We have an automation process, which, believe it or not, is incredibly hard. Even though if you're very tech savvy, yeah, you probably are very good at talking to the LLM and getting stuff from them. But to automate all your process, that takes a lot of time. So people kind of confuse these two together. First, augmentation, which adds job, then automation, which should cut lower skill jobs. Then you have capital deepening, and I think it's very important, and I'm going to focus on these two, automation and capital deepening, to give you an example of why we have to have a fluid view of the labor market and not get caught up in the displacement story. Capital deepening in the US is a massive thing right now with the big, beautiful bill and with the AI plan, as you kind of commented earlier on. They're telling us that they want to win the AI race. And how do you win the AI race? Well, you're going to facilitate, constructions of data center, data center plugging to the energy grid, et cetera, et cetera. But there is a really good case study, and this company called Hadrian. Basically, they produce AI factories. They work on the defense sector. This is not an endorsement, but they're actually doing something very interesting. And I thought it was very different and opens my mind for a lot of different views. So what do these guys do? Their fundamental view is that we need to build full stack AI factories in the US. We have a shortage of skilled talent in manufacturing. The CEO Powers, comments on the fact that most of the people that knows how to bend steel or metals in this country is like 65 years old. So we don't really have a generation that is kind of rebuilding that. He also mentions that obviously we'll kind of get divide the manufacturing is a national security thing. We see how China is progressing, so we have to have a US industrial policy. So here's the interesting stuff. In order to replace the labor shortage and to use the power of AI, our competitive advantage in the US, they're building just basically full AI factories to build what used to be built by humans. So here's one thing. The uptime and utilization of factories in US on average is 20%. With an AI factory is 80%. And this is what really, that moment where he had me at hello, is he comments on, the productivity. Basically from 80 hours to do something to 8 hours. And this one was really mind-blowing. Their workforce is non-tech, non-software. It's basically people that didn't have skills. They came in, and in 30 days, they taught them how to run a machine, an AI machine. And now they say they have people that has no education, but they've been trained and can run 10 machines in parallel. That compares to like the Japanese classic, know-how in a person that has the know-how in manufacturing that takes 5 to 10 years to train. So that, why do I think it's kind of really, really important? Because you have this intersection of reindustrialization of the US for national security purposes, and we're putting policy tailwinds in that direction. You have also the AI revolution. It's very natural to me to think that how the US is going to tackle this is we're going to be just advanced AI factory manufacturers, and we're going to replace a lot of the production via AI factories. This is obviously very bullish for the AI story, but also has very important implications for the labor market, because if I tell you this and I tell you that you can actually train people with no skills, well, all these young kids that know how to talk to the LLM, now they have a pretty great avenue of like running AI factories, better than the older crowd. It's a long answer, but I think it's very important to kind of tackle many things.
Yeah, there's a lot in there, and unfortunately, we're running low on time. But there's always more to talk about with you than we have time for. But just to kind of bring that together, it sounds like what I'm hearing is that the job displacement worries about AI are getting way too much attention in the market and are overblown, and people are underappreciating the productivity gains that are going to come from AI. The younger people in the workforce are going to benefit a lot from this and be able to make a much more enormous impact and contribution to our economy. And I think that, something else you said earlier about the Federal Reserve, right? Like a lot of the members of the Board of Governors of the Federal Reserve themselves are underappreciating this impact of AI. And so so everybody needs to kind of like pay attention and stay dialed in so that they can understand this technology, but also understand the implications of it on the macroeconomic framework, because it's going to be much bigger and different than I think a lot of people are anticipating right now. As I said, unfortunately, we're running low on time here, so I want to give you, a quick answer for the last thing here to wrap us up. Going into the second half of this year, right? There's a lot of people who are hawkish, who are dovish on Fed policy, and a lot of people with different opinions about the effectiveness of this Trump AI action plan, this huge effort to grow the AI economy in the United States. What's the single most important thing for people to stay focused on as we go into the second half of this year from a macro perspective to see which direction things are likely to play out?
Yeah, good question. And reduced dimension answer is, I think Q3 is probably going to be the lowish point on consumption. We have the summer tailwinds that generally help, but we're probably going to see a proportional reaction from the consumer to price increases in tariffs. It's been already a couple months, and price propagation at some point is going to be very clear. We're already seeing prices impacted in the previous CPI, so I kind of believe that the more we get these price increases, the consumer reacts proportionally. So that means consumption will stay kind of weak, in my opinion. We have a downside risk from what I mentioned, the TPS, so the temporary status. All those job losses may actually happen in Q3 into Q4. And then I think the other part is on the inflation side. Yes, we have the tariffs, but I think that the housing market is also providing an offsetting force that is not very commonly talked out there. But in my numbers, you could probably see half of the tariffs increases this year being offset by weak shelter. So if you combine all those three and then you put them in a risk-centric kind of regime, you're like, well, maybe my policy needs to be more dovish because I may have more negative surprises than I fear in inflation, and maybe I have more negative, more weaker consumers. So that means a reaction function that should be more dovish. So I expect that the Fed is going to cut in September. I think that there's probably 3 cuts for the rest of the year. That was on the dovish side, but all it will take is just some clarification that consumption remains weak, and then we're seeing these labor job losses happening.
Gotcha. Awesome. Well, I appreciate that. It sounds like what I'm hearing is we're expecting some dovish policy, which should support the continued bull run and the continued investment and growth in the economy that we've seen. So that's great news to hear. Thanks for that analysis. Wonderful to have you on the program, PDS. Everyone, just a quick reminder that nothing said on this stream was financial advice. This is all just content for educational and entertainment purposes only. We are not financial advisors. The views and opinions expressed here are our own and do not represent professional advice. So seek help and a financial advisor if you are looking for that. One final reminder, if you are listening to this episode on the Milk Road Show, these macro episodes will soon be only published on the Milk Road Macro channel. So YouTube, Spotify, Apple Podcasts, wherever you get your podcasts, make sure you're following us there. Subscribe to our newsletter because I said we're going to be having a lot of analysis coming out about the results of the FOMC meeting and other macro factors you need to know. So stay engaged, stay connected there. And that does it for us today. Thanks so much for joining us. Have a wonderful day. Stay informed, stay bullish, and we look forward to seeing you on the next episode of Milk Road Macro. Thanks so much, everyone.
And finally, I've got to give a shout out to our partners over at Nexo. Have just partnered with the DP World Tour, one of the leading golf tournaments in the world, 45 tournaments across 4 continents, and they're going to have the Nexo Championship debuting this August in Scotland. So keep an eye out for that, because this is one of those things that feels very marketing talk, but I get super excited because when you think about sports and the crossover with the attention that it has and how many leading global brands are sponsoring massive sports tournaments, it's pretty exciting to see crypto brands sponsoring large sports tournaments as well. So hat tip to Nexo. Way to go, guys. Thanks as always for doing what you guys do in the space. Thanks for tuning in, y'all. Have a wicked awesome day. We'll see you back again tomorrow. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.